All right. What do you see on this chart here? And anything of note? All right, I guess that could be a pretty picture. I'll go with that. Christopher, where is that unfilled gap? Michael, where is that huge gap? Okay, Golden Cross was below the market here. Yep, see that. No, that gap was filled. Yeah, it's the one from last July. Okay, right here. All that dead space. And that gap to be filled would be right here at about 188.75 or so. Not too far off from where we're trading right now. In theory, and from a technical standpoint, that should actually be some pretty significant resistance. Okay? So right there, actually about 188.60-ish, should really be significant resistance. Above that, I see some resistance around 193 or so. But this is what really stands out to me, this gap. Okay. On the downside, you know, I think that support-wise, this area just kind of right in the middle of the 50 and the 200 day, which is a fairly wide range. But this area right in, you know, here where all of this trade was, which is right in the middle, so about 165-ish or so, is some pretty good support. But that's obviously well below the market. So we're detailing, you know, like 165 up to, what did we say about what was that? 188.5. 165 to 188.5 in terms of technical support and resistance. Okay? Now, that's not going to coincide right with the expected move. And we're going to look at the expected move here in a moment. So let's get a whiteboard going here. Remember, 165 to 188.5. Stock is 183. What is our expected move, guys? It's right about 11 bucks. Okay, so if we look at 183, the 182.5 straddle, which is the closest straddle, is trading about $11.50, right? And it's 50 cents in the money. So that gives us pretty close to an $11 expected move. Okay, so that gives us then a range of 172 up to 194. Now, we had said that there is support down at 165 and resistance up at, I keep forgetting that number, I want to look on my chart over here. And that was 188.5. Which was a gap. Now, we also saw above that gap, that yeah, there was also some pretty decent resistance right around 194.5 or so, which coincides right with the expected range. Okay, also some very good resistance up at 195. All right, so I look at Facebook here, and again, I look at this chart, and I don't know, I honestly don't have a feel technically, fundamentally, for a direction. Okay, so let's look at an iron condor. Let's see what that is. Whoa, what just happened there? What did I do there? Did you guys' screen just go blank? I don't know what I just did, but I'm piecemealing everything back together here, guys. Sorry about that. Literally no clue what happened. There we go. Well above my pay grade. Okay, I think I got everything back now. Okay, let's look at an iron condor. That's a fat finger slip there, Avi, that I had. Okay, so an iron condor, 172 and 194. Let's see what we got. Okay, so this is a $5 wide iron condor. We would want to see on a 1-to-1, we'd want to see $2.50. That's not trading 2.5. This is trading about 230. But let's see the break evens on this thing. Okay, so the 175, 170, and 192.5, 197.5 iron condor for about 230. Break evens here, 172.70 up to 194.80. Okay, so we're pretty darn close to the expected range. But once again, we're not seeing that added in volatility like we've seen coming into other earnings cycles. Okay, so from a reward to risk standpoint, 230 over 270 on this. It's not horrific, but you know, it's only 85%. What I like about this one is the real defined resistance on the upside. So even if it breaks through that gap that we're looking at 188.5 or so, that next level of resistance is right in line with the expected move, which puts us to that break even. It's the downside that concerns me on this one. It's that downside area around 174, which is our break even, which technically, I guess there's some support there, but, I don't want to just force something like that. But I do like this iron condor. I think this is a worthwhile one. Now, I don't want to just go out there and sell this thing for $2.30. Okay? If it gets to the end of the day, we may consider to do that. I would love to sell this a little bit higher. I would definitely sell this for $2.35 right now. Oh, printer ink. Beautiful. Thank you. Thank you, thank you. Hoping that's what this is. Best part of the day here, guys, outside of working with you guys, is when an Amazon package comes. I think this is my printer ink. Let's see. Oh, yes it is. Giddy up. Now I can print. Beautiful. All right. Anyway, back here. I like this iron condor setup, guys. I really do. I just want to see if we can get a little bit more for it. Any questions on this? I'm going to send this out. And again, I don't see a directional bias here. Up or down. I do not see that directional bias. Okay, so we're going to put this out here for $2.35. This is not going to fill right now. It's not going to fill. Okay, we will, however, just monitor this throughout the day. If vol does tick up a little bit, okay, great. If not, we'll reevaluate. Now, one other caveat here. We're using, in our assessment here, we're using the stock price where it's trading right now, 183, right? So the value of this iron condor, where it's trading right now, is $2.30 with the stock at 183. However, if the stock starts to move significantly from here, okay, the price of the iron condor probably won't change much. However, what will change, which will affect our assessment? Okay, what will change? Yeah, the break-even range, because the expected range is going to change. Right? So our price of $2.30 or $2.35, whatever we wind up selling this at, that's based on the strikes that we're using because of the expected range. So we need to really closely watch where the stock is trading for this to be valid. The stock goes to 185. I don't want to sell this at 230 because I would probably want to adjust my strikes. The stock goes to 180. I don't want to sell this at 230 because I would probably want to adjust my strikes. Okay, so we're going to put this offer out here. It's going to have a fairly tight range of where this is valid, and we have to be cognizant of that. Have to. Sure, Chuck. Right now, we're calculating the expected move based on where the stock is trading right now at 183, right? So that expected move is probably not going to change even as the stock moves, because the option prices are going to, hold their values. However, if the stock, let's say, rallies to 185, well, now the new expected range, if the move is still $11, is going to shift upwards to 174 to 196. If the stock drops to 180, but the expected move stays the same, now that expected range is going to shift downwards to 169 up to 191. So we always want to, especially on an earnings play like this, where that range is, that the option market is predicting, is so critical, we always want to have the quote-unquote best starting place. Meaning, in a perfect world, we'd love for the stock to be here at the end of the day so that our assessment of that range is most accurate. Does that help out? Does that make sense at all? No, most of the time it doesn't, Chuck. Most of the time the iron condor is going to stay the same price. The expected range is going to stay the same. However, the expected move will stay the same. However, if the stock price shifts, that moves that range. So what we may want to do then is construct a different set of options to come up with our iron condor, adjusting the strikes to fit better within what that new expected range may be. Okay, again, the more you do this, the more you see us go through these examples, the more familiar you're going to become of how we go about calculating what the best type of trade might be, reward to risk, this, that, and the other. All right, let me get this recording put up here. Let me get this. You're very welcome. No, Alan, no. That's way too wide. No, I'm talking about really tight. I'm talking about like 182 to 183. Maybe a little bit wider than that. Give it a little bit of room. But no, that would be way too wide. Okay, let's before I sign off here, let's take what Alan just said here. Okay, let's say the stock was 180. Instead of 183, okay? And the expected range, or the expected move, was still $11, okay? Well, now we're looking at a range then of 169 up to 194. If we use the same iron condor, look how that break even now compares to the expected range. Okay, it obviously is better for the upside, because if the stock has dropped, it gives us more, right, exactly, it gives us more room on the upside, but misses badly on the low side. And now if we do the same evaluation here, was 185 instead of 183, and the expected move still $11. Well, now we're looking at an expected range of 174, which would be fine, but now the upside is now 196. Okay, now if it went up, let's say to 184 or so, based on everything we've talked about, and Alan, I'm actually very, very glad you brought this up. Okay? Based on everything we talked about, with where there's some support, where there's resistance, where would I err on the side of caution for where I would like this to be valid, for the stock price for this to be valid? I kind of hope I'm making myself clear. I don't know if I am. Did you guys kind of understand what I said or not really? Because it was definitely vague. So remember, back at the beginning of our discussion, when we were looking at the charts and looking at the technicals, on the upside, there's some very good resistance at that gap area of 188 and change, but then there was another big, heavy area of resistance like around 195. Okay? So that heavy area of resistance of 195 gives me a little bit of solace, a little bit of comfort, protection, that maybe the stock doesn't get all the way up to 196 on that new expected range. If the stock were trading 185 right now. See what I'm saying? There's more resistance to the upside than there is support to the downside. So if anything, I would allow myself a little bit more room to the upside in this range where it would be valid, but less room to the downside. I want to be pretty tight to the downside. Does that kind of make sense? Fred, yeah, caution on the downside. All this goes into, really calculating what the best strikes are to use. And obviously at what price, but what the best strikes are. Okay, so going back to the reward to risk, how wide, Fred and everybody else, how wide are the strikes on this iron condor? Okay, $5, right, Fred? The call spread and the put spread, they're each $5 wide, right? Okay, so if we're collecting a credit of $2.30, then our maximum risk would be $2.70. So there's our reward to risk of 230 over 270. Now, let's say we're able to get 235. Doesn't seem like a lot, right? A nickel doesn't seem like a lot. But look what it does on the reward to risk standpoint. Okay, it changes up to 89%. That's pretty significant. Really, really good questions, everybody. And so as we're talking now, and I know I don't have it up on the screen, as we're talking, Facebook is actually drifting down just a little bit, okay? Look what it's doing to the value of this iron condor. It's actually making the iron condor worth a little bit more. Makes it more likely that we could get filled here on the downside because now that whole risk is shifting down to the downside. Well, yeah, Chris, on an iron condor or a range-bound type of trade, yeah, we want it to stay within that expected range. Especially if our, the break-even points are at or outside of the expected range, then yeah, that's exactly what we want. So I'm still okay with putting this out here at 235 right now, and now there's actually a very decent possibility we may get filled. However, there is going to be a very, very tight range here, guys, to the downside, where this is going to be valid, like tight almost to the point of, you know, like 182 and a quarter, and that if the stock slips below that, we don't want to get filled. Now, if we get filled before that and the stock moves down, okay, then, you know, we keep it and, you know, we'll live with it. But if the stock starts to slip down below that, I may want to adjust my thinking. Okay? Everybody with me? Everybody okay if I get that signal out now? Okay, so for some of you new people out there that may be hesitant to ask some questions, this is a perfect example. This discussion on Facebook is a perfect example of you guys asking some questions that you want to know the answers to and really spurring some good conversation and good education about why, when, how, where. So don't ever hesitate. Well, Constantine, when we factor an expected range based on the option market, that expected range, so based off of the straddle price of the expected move, that is a 1 standard deviation probability, so roughly 67%. Okay? So it's not just this trade, Constantine, but any trade that we make, which is based off of the expected move and expected range, if we're using the strikes based on that probability is 67% of a move within that range. Okay, so now we see that Facebook actually dipped below that 182 and a quarter spot, where we would theoretically want to, you know, potentially not get in this. What should we do? What should we do? Okay, so if we adjust the lower strikes, guys, watch what happens to the value of this, right? Why did the value go down? As well it should, but why did it go down? It's less risk because our expected range now, or the break even to the expected range, just moved significantly, right? Let's say, and I'm just going to round this off here, guys, to $2. Let's say we were able to sell this for $2, not the $1.95, okay? Now our break even to the downside is all the way down to 170 and a half, thereby reducing the risk of the entire trade. Now, it also would reduce the upside as well. So now the upside break even is 194.50. Okay, if we compare that to the break even before, we had a break even down at 170, or excuse me, 172.70 and 194.80. So I'm still okay with the upper end. I'm still okay with the upper end there. We now have lowered that risk on the downside. Well, if we're lowering risk, we're going to get paid less for that, right? If we raise our risk, we should get paid more. If we lower our risk, we would obviously get paid less. And that's exactly what's happening here. So maybe that's a consideration. Maybe we want to take less risk, take in a little less. Okay, Kevin. In terms of lift, I'm not sure what you're talking about because we did not have anything new in lift today. In LRCX, there was nothing filled on the revalidation on the opening side, but there were fills on the partial exit on the sell side. Okay, so in a perfect world, guys, with Facebook, you guys hit the nail on the head. We would want to adjust our strikes down. Or we leave it as is, assume a little bit more risk, but we're getting paid the additional credit for it. So here's actually what I want to do. I was all set to put this signal out here. I want to watch Facebook trade a little bit here instead. We're in no rush to put this out there. Yeah, if we're going to do something, we want to do it before the end of the day because earnings are at the end of the day today. I want to watch this trade a little bit. I want to see if this thing is going to break down here below 182. If it does, okay, then maybe we adjust those strikes or maybe we don't do anything at all. If it hovers here and starts rallying back a bit, okay, then maybe we put our signal out there. Okay? We need to let the market come to us. We can't chase the market. Okay, understood? Sure, let me, John, let me just get this recording done, put this up in the room, and then I'll go to the Analyze tab on Thinkorswim. Well, Rob, because it already breached that area that I was comfortable with selling this at 235, which was like 182 and a quarter. So now I could put this out at 240, which we're not going to get filled at. Or we could go back and adjust these strikes. Okay, and try and get that for $2, which that reward to risk, doesn't meet our reward to risk criteria. However, it's not an apples to apples comparison because we're also moving the needle on the break-even range. So that's why, Facebook is down 70 cents or so since we started talking. I want to watch this trade a little bit. I want to get a better handle on what's going on out there. 70 cents is not a lot, obviously, on a $180 stock, but in the time frame of the 30 minutes that we've been talking, that could be, could wind up being the make or break of our decision on the trade. All right, let me get this all up there, and then I will get to the Analyze tab, okay?